If you didn't find the pod on Friday, we were off shooting a commercial. Part of the challenge of doing a podcast is to get subscribers. So if you like us, don't forget to hit the red button. Forget what you've been reading and all the other data you've been parsing to get a handle on what markets might do. Tomorrow's CPI report is the holy grail of data this week. It's a measure of inflation being felt by consumers. That's us, you and me. And if that's not enough, on Wednesday we get the PPI Producers Price Index. All right, let's get started. Welcome to the Money Runner. It's Monday, September 12th. This is your Market Minute. I'm David Nelson. Last month, the CPI came in modestly, but still 8.5%, obviously untenable for the Federal Reserve. And as we pointed out on this pod before, history would dictate the Fed would have to jack rates all the way up to that number and possibly beyond to bring it down. They can't do that, despite the tough talk from Powell and the other Fed officials. However, they can jawbone it and try to talk down inflation expectations, and that's exactly what we've seen in the last few weeks. We've seen a parade of Fed officials step up to the microphone and uncharacteristically support the idea of higher for longer. Taking it up to the current inflation rate would knock inflation down, but the unintended consequences that come with it would be more than I think the Fed would permit. All right, let's shift gears and talk markets for a second. Last week was a strong one for risk assets. The S&P 500 held the all-important 3,900 level. Why is that important? Investors love pictures, and holding 3,900 kept stocks in a channel drawn from the June lows. There were a couple of attempts to break down, and positioning on the short side was very heavy. After failing to break meaningfully through 3,900 on the downside, I think shorts were forced to cover. And of course, the only way they can do that is to buy stock. All in, the S&P put in its first up week in 4 at plus 3.68%. One data point that we should know from Friday. I've been talking about the importance of the terminal Fed funds rate, or the implied target of how high the Fed might have to raise rates over the next year. I've also pointed out that despite the tough talk from Jay Powell and company, estimates had moved little since Jackson Hole and were still below 4%. On Friday, that changed, and we hit the all-important 4% level. On its own, only a single data point, but it certainly needs to be watched. If the Fed is forced to hike meaningfully above 4% on a sustained basis, it won't take long for the unintended consequences of such action to be felt in every part of the economy as well as markets. If you like today's pod, please hit the subscribe button and leave a comment, good or bad. Helps us get better. I'm David Nelson.